Very good evening, everyone. And first of all, thanks a lot for joining. I know immediately after market hours, it's relatively challenging for someone who is just looking at a close eye on the market, and our market has, anyways, been exciting for the last 3-4 months at least, I should say. So, to all our investors, I know this is one thing which is troubling each one of them. That some part of the portfolio is really rewarding and running like a horse, and some part of the portfolio still probably yet to take off. What I'm referring to is the various industries where you the way the markets are behaving. So if you see probably if as a customer you are holding IT as a stock, and you are watching it, probably you may not have got the kind of returns which probably another sector could have provided. So to cater to those queries and to understand why market moves in various cycles, and understand how fund managers work around it, we have Mr. Anthony Heredia. I'll give a quick brief about Mr. Anthony, but before that, I just want each one of the investors please understand about this product. We are talking about something very different, which is coming on the shelf from Mahindra Manulife as an AMC. The objective out here is to make you understand how things move, and obviously to understand what is there and offering for all as an investors. So a quick brief about Mr. Anthony. Mr. Anthony Heredia is a chartered accountant and has over 27 years of work experience in investment industry. He has held various senior roles, starting as a managing director of Morgan Stanley Investment Management, CEO and whole-time director of Baroda Asset Management, and CEO of Bank of India Exa Investment Managers Private Limited. So he has worked across sales, marketing, and investment domain, and that's what the expertise he bring out for all the investors out here. This will be a call where Mr. Anthony will take us through how they are seeing the market, and from the glimpse of a business cycle perspective, and they are coming with a new fund offering, and what is there on the table for investors who are just not, I'll not say confused, but yes, they are referring to various newses and various aspects on various segments of the market going up and down, and how holistically a portfolio can be created is something which and Mr. Anthony will talk about. Mr. Anthony, over to you, sir.
Yeah. Thank you, Abhishek. As I often say this, it's an extra pleasure to be presenting at HDFC Securities because obviously I'm a guest speaker, but I'm also a happy customer. So from that perspective, we always kind of find this unusual, right? I'm a user of the platform. I'm a customer of HDFC Securities, and today I'm presenting to fellow customers. So that's always a very unique experience. So thank you for the opportunity. I will take about 30 minutes, but sometimes when you start discussing new offers, there is a worry that people have that here is someone who's going to sing the praises of this new fund, and beyond a point, you're none the wiser at the end of the presentation. I am actually going to spend almost 80-90% of the time talking about probably why it's relevant to think about investing in a slightly different fashion. Abhishek did refer to the last 3-4 months being particularly confusing and challenging, but I think, frankly, I could extend that argument beyond the last 3-4 months. And I think the fact that markets will be dynamic, sectors will keep rotating, themes will keep emerging and disappearing is, I think, something that we should deal with as part and parcel of life. Right. So I'm going to start with, we are often, when you read the newspapers, you look at Twitter, you look at WhatsApp University, often we are used to following the quotations of Warren Buffett. But there is another investor I just want to reference here. He's actually within the investment framework and investment world, a very, very respected investor. Some of you may be reading his monthly notes that he puts out, his memos. His name is Howard Marks. He's typically a fundamental growth investor, but there are 2-3 things that he holds very dear to his heart in terms of how he looks at investing. The first point being that nothing in life is secular and guaranteed. Most things in life and therefore surely in markets will prove to be cyclical. And the second being that because sometimes people in the market forget this fact that things are cyclical, the greatest opportunities or the greatest dislocations come in terms of making money or losing money when you forget that fact, right? So I think that's the first premise that kind of encompasses this fund idea, which is the fact that yes, you look at buying a stock focusing on growth of the business, valuations, cash flow, management quality, etc. But one of the more important things that one should also keep in mind is effectively the kind of economic or business cycle that is relevant to that particular company at any point in time. And also equally importantly, how is the market valuing that particular opportunity? Because like Howard Marks says, often the chance of creating alpha or above natural return happens when you are able to spot that dislocation. The first point I just want to make, and this is true irrespective of the last 3-4 months, it's irrespective of the last decade or two, economies will always work in cycles, right? It is not a linear equation. It will work in cycles. There will be a period where you will see an economic recession, and we have had multiple conversations in the last 1 year in particular in terms of whether the West and the US is heading to a recession or not, and so on and so forth. Uh, Typically, from a recession kind of situation in an economy, you will naturally move into a situation which becomes a little more promising, which is what we would refer to as an early cycle of recovery. Business activity starts to pick up, credit growth starts to move from being negative to slightly positive, sales growth starts to happen. As you can see from the slide, sales growth starts to happen with low inventory because in a recessionary environment, most manufacturers or most service providers have become a little nervous about demand, so they dial down the production. And so effectively, you start to see sales growth with low inventory. You move to a mid-cycle where over the course of the mid-cycle, you obviously move from a situation where the economy moves from being reasonably good to very good. Credit growth starts to become strong. Profitability peaks, and I would make this point, moment you're related to markets, it doesn't mean that profitability is going to peak for every company and every sector at the same time. And I will talk about how there are some very, very clear correlations that happen. And if you are able to pick the right correlation, it kind of makes you add alpha versus not. And then you move to a late cycle. I mean, just think about close to end of 2000, think about 2007, etc., where if I was to describe it in an emotional context, everybody thinks that the only thing to do is to buy equity, right? And as often gets proven, irrespective of the data and the charts that get shown, the markets and the economy behaves very, very differently. And I'm just trying to correlate these economic cycles to markets, right? In a recessionary kind of environment, you would tend to see the dominance of defensive sectors like pharmaceuticals, technology to a limited extent, utilities, consumer non-durables. I'm just going to go quickly to the mid-cycle, right? Because I think one obvious question people are going to have is, where are we right now? In our view, we clearly are in mid-cycle period. And I think that will automatically explain at least the last 12 to 18 months in terms of the sectors that have done reasonably well, right? Banks and NBFCs, auto, real estate, consumption, cap goods, industrials, at a cap level, mid and small caps, because it's an environment where things are picked up quite significantly, and the more nimble you are, the more active you are, the better opportunities to make money. And then you move back to the late cycle, where ideally you should be back to what you would be owning in a recessionary phase. But as I said before, and as all of you I'm sure have experienced over past markets, it rarely happens like that. You will probably end up holding even more higher beta names instead of perhaps moving to defensive. But the central premise of our new fund is this, that effectively there are cycles in the economy, there are cycles in the market, and if you're able to read dispassionately where you are in the cycle, where opportunities exist for certain themes and sectors, and where opportunities do not exist, that is when the opportunity comes through to make a little more money. Having said that, let's be clear on one thing, and Abhishek did refer to this, which is that okay, there is confusion about, why is this part of my portfolio not doing well? Why is this portfolio portion doing extremely well? But in my engagements with customers, and I do a lot of that, I would put it in the perspective in terms of I see customers being confused and therefore asking either of two questions. And I want to use this time to kind of help focus your energies on what I believe is the right question. So there is one set of people whose obsession is with the current level of the Sensex and current level of the Nifty, right? So whether the Nifty is at 18,000, 19,000, or the Sensex is at 65,000, every question or every minute is engaged with the fact that can 65 become 100,000, can 18 become 36. There's a different strain of thought I want to put forward to you, which is a separate way of looking at it. Is India likely to become the third largest economy over the next 5 to 7 to 8 years? In number terms, what does that mean? Is India's $3.5 trillion economy going to become $6 trillion? And if you focus your energies on that particular aspect, then I think a lot of your answers get clearer, right? Because I think there's reasonable conviction given where we are as a nation, given our demographics, given the opportunity set, given the policies, the fact that we are, like I said, can you ask me to give you with great conviction that will 65, 67 on the Sensex become 100,000? My answer will be, I don't know. I know it will happen one day. I can't define time frames. But do I think the economy will double in the next 6 to 7 years? I would say I am reasonably confident of saying that that will happen. And then you just take a step back and see for yourselves that inevitably there is a almost perfect long-term correlation between the market cap of our stock market and the GDP. Right? So the argument I'm saying is just think about it this way. As long as you're convinced that the GDP will double, you should be convinced that give or take 1 or 2 years, either before or after, the market cap will double, which therefore means that if you broadly invested in the market, your investments will double, right? And therefore you then focus on the emotional management of that journey rather than the intellectual management. And the next slide also just talks a little further about this, which is eventually the reason for market cap and GDP being so closely correlated is because company profits obviously are also correlated, right? I mean, if you think, let's say over the next 7 years, the GDP will grow at, let's say, 6.5%. Let's assume inflation is 4.5%. Effectively, a nominal growth for an economy being 10%. As a corporation, I would have the confidence that I can do a little better than that, right? There will obviously be sectors and companies that may not do as well, but at a broad level, one would argue that corporate India profits, if the GDP normally grows by 10%, corporate India's profits will grow by 12, 13%, right? And so that's where I would make the first point of call that in the long term, eventually there is a fundamental correlation between economic growth, profits of corporates, which is effectively earnings, and therefore eventually market cap. But the point I also want to make to you on the same slide is look at that journey, which is long term. Right now in front of you, you're seeing a 22-year journey. There are many points where they intersect, right? But there are also significant periods where they don't. And that is what we refer to as, are there opportunities in calling the right moment in the cycle to be able to then orient your portfolio towards sectors that would clearly be benefited at that point in time versus portfolios which will not. Why am I saying this? Because this, I think, again, was referred to as the start of the conversation. I'm not sure how many of you have actually looked at the market return in this context. So basically what this does and says is these are different sectoral indices. So they represent the opportunities that companies in these sectors have delivered in terms of returns, what should be very, very clear and obvious to you is that the possibility of making a call, a secular 5 or 10-year call saying this is the sector that will outperform every single year or every single 2 years is impossible, right? It's almost certain that certain sectors actually after 1 or 2 years of performance dip. And the reality is it's not the law of averages. It is just the fact that, as Howard Marks said, everything works in cycles. There is a time when the cycle is good for somebody, and logically that cycle being good for somebody is conversely not so good for somebody else. Let me give you a very classic example. I'm sure all of you are investors in bank stocks, right? Today, as we speak, the net interest margin or the NIMs of banks are at an all-time high. And that's what always happens towards the peak of an interest rate cycle, right? Because just think of you and me as consumers. Every time the RBI raises the repo rate, what happens to our home loans? What happens to the EMIs on our personal loans? They get reset pretty much the next month. Do you see deposit rates getting reset pretty much at the same period? The answer is no. And so therefore you reach a point where the lenders or the banks have a period where their profit margins are at the highest. What would you expect from a cycle perspective when you believe that the interest rate cycle has peaked and it will start to come off? You will actually see potentially the reverse of that situation, right? You will actually see that the EMIs you pay remain static or actually start dropping. But in order to fuel their further growth, banks start increasing their deposit rates, which you've clearly seen in the last 6 months as well. So effectively, if I was to say from a cycle perspective, how do I think about it? I would just make the argument that the game is moving from the lender to the borrower. And so then let me look at the borrowers who, let's say, the market may not have been as kind to, but who clearly, visibly will start to see earnings pick up because the lenders are no longer holding sway. And even within this, let me give you an example, right? I mean, just think of it. It's almost like a statistical quirk that from 2005 to 2023, a period of 18 years, the Nifty and the financial services index have given an identical CAGR, 17.3%. Okay. So you can't think that, okay, so if I invested over an 18-year period in either of these two, it didn't really matter. Yes, from one side, I would say the argument is right. But just take a look at this. In the same 18-year journey, what you see is the index is eventually converging, but just take a look at the way profitability growth has changed, right? The red dot depicts the profitability or the earnings growth for financial services. The green dot depicts it for FMCG, right? So the point is that over shorter periods of time, there will be inefficiencies because the earnings growth between these two sectors are different. And not every single time, because that becomes momentum investing, which we think is only a fool should try to do. But if you can get even 2 or 3 calls in terms of the shift of earnings between these two sectors correct, while holding a broad position in both these sectors over the period of time, that's how you are able to generate an alpha over the 17%, right? Let me give you another example, something that's very topical, right? You've seen PSU banks really do extremely well in terms of stocks relative to private sector banks. Why is that the case? For many, many months or years, you've heard people who talk about markets on television, fund managers, fund houses, typically say, no, I like private sector banks. But the fact is, there will always be times when, from a cycle perspective, the earnings growth of public sector banks will outshine private sector banks. And whether you like it or not, markets eventually reward earnings, right? And so the ability for you to predict when perhaps the tide is shifting in terms of opportunity in the cycle from private to PSU banks gives you the opportunity to create alpha. And let me make another important point. It is equally true the other way around. Let's not think of it as one direction. This is not a discussion of when is the right time to enter. This kind of approach is also thinking about potentially is there a right time to exit something and move into something else as well. This is another example which is really beautifully depicting how something that wins sometimes results in something that loses, right? You all know that metals is the key raw material component in auto. Just take a look on the left hand side, 2011 to 17, you have a situation where metal companies, metal prices have been soft, and therefore, as a consequence of the key raw material prices being low and demand being reasonable, look at how auto profits have gone through the roof, and look at how the situation is absolutely reversed in the next 5 years. Right? So if you were to take a call saying, no, auto is great and I will stick with it, without recognizing that one of the key constituents or contributors or linkages to it has changed shape, the ability for you to recognize that and reorient your portfolio is where business cycle investing starts to play in, right? Which is that you think about where the cycle is turning for a particular sector or a theme, and where is the cycle starting to become more and more relevant. And I'm not going to go into detail on this slide, but I want to give you an example saying that what the trigger could be in terms of a cycle turning could be multiple things. You look at the banks and NBFCs that are referred to on the top left, right? I talked about it, it's all linked, right? If you believe the interest rate cycle has peaked, which for example at this juncture we clearly do, it will then mean that NIMs will peak for banks and NIMs will start to pick up for NBFCs, because NBFCs rely principally on banks for funding. And the moment banks become into a situation where they're becoming a lot more willing to lend to NBFCs because they do earn a higher rate of interest, then NBFCs are in a bargaining position. They are able to grow their credit far quicker because they lend to parts of the market which is not traditionally what banks sometimes do. And so therefore this actually cyclical change is what explains why there is a shift of momentum in some sense from banks to NBFCs, right? Take the third one on the bottom, FMCG. There are things that you have to take a call on from a cyclical or a top-down perspective. What is the opportunity? Is it that the rural economy is doing better? In that sense, is there parts of consumer good companies that are predominantly rural that I should focus on? And there will be times when clearly the game is within demographics and urban consumption and so on and so forth. Healthcare, another example. Obviously, healthcare is a very broad term. Pharma is a very broad word. Honestly, lots of themes playing out very differently there, right? Is there a large opportunity for domestic demand in pharma? Is that cycle turning? If that is the case, a particular set of pharma companies start to look more attractive. Is generic bulk drug pricing in the US settling down and no longer dropping? Is that an opportunity for generic manufacturers? Are more and more of the Western world moving manufacturing to contract manufacturers in India? Then that becomes a separate business cycle opportunity for companies in that space. The point I'm making is every sector has certain constituents that drive its cycle, and your ability to think about it and then act on it if the market is not perhaps pricing it perfectly in your view is where the opportunity when you think about this approach comes in. The other factor I want to bring into play is something that I don't think we have thought too much about in the last 5-10 years, but is increasingly becoming relevant, and I think will become even more relevant. We are now a marketplace where passive and ETFs play a very significant role. In my role, unfortunately, I can't talk about specific companies, but I think right now we are visibly seeing the impact on a specific company just purely on the back of index fund readjustment, right? But I'm just throwing a different example. Just look at this graph. Look at the index weight change in just banks and diversified financials. 14% change in the index, which means that a lot of the passive flow inevitably gets increased to banks and financial services over the last 10 years. So it's not rocket science or some coincidence that banking and financial services has now become such a relevant part of anybody's portfolio. It is also something that the index constituents and the way that behaves is something that is important. I'm going to the last part of really the argument as to why one should think about this kind of investing concept. This is one simplistic way. Think about what I said at the beginning, right? Our GDP potentially will grow and double in the next 6 to 7 years. So I could take a stance and say, as long as I'm broadly invested in the Nifty or the market in these proportions as these companies represent, I should be good, right? But let me give you a perspective. This very same Nifty 500, and it's this I've just expanded. I've taken the profit pools of 2,800 companies listed, which is effectively, I would say, 97% of the market per se. This is the absolute contribution of profits to the total profit pool of the market, right? Clearly, financial services is a very, very big constituent. Energy, probably driven principally by Reliance Industries, private sector banks, and so on and so forth, right? Now, that is one way of looking at it, saying, okay, so broadly, GDP will double, market cap will therefore double, everybody will double. Or do you see value in looking at where a cycle for a particular sector is changing, and therefore is the incremental contribution or reverse the negative contribution starting to come in, and does that give me a perspective of how I should approach it? So look at the same period and look at how the incremental contributions to the extra profit that the Nifty 500 is generating is moving. Does that now give you a better perspective as to why telecom has done far better in a sector in the last 2-3 years, right? Metals over the last 3 or 4 years, obviously in the last 6 to 9 months, it has been not so much. But also think about what I said in the beginning. This is an as-of situation. If I'm taking a perspective and saying, in some sense, the game, for example, is moving from the lender to the borrower, is it possible that incremental profits in FY24, 25, 26 don't necessarily come only from financial services and banks, but it perhaps comes from other spaces as well, like industrials, like cap goods, etc., and drive or use that to create what I believe is an optimal portfolio. And again, this is just a perspective that eventually, even at the broad sector level, there will be multiple constituents, and therefore you cannot say that I have a cycle that is a consumer cycle. Yes, the argument is, what does India moving from a $2,000 per capita going to $5,000 mean? What I'm saying is, it will mean different things for autos, it will mean different things for retail, it will mean different things for tech platforms, right? And your ability to therefore analyze that and believe that the cycle is turning for a subset of these sectors is really what you use to potentially either create alpha or make sure you don't destruct alpha by making sure you exit spaces that the cycle is not really favorable. Very, very quickly on our fund, just 3 or 4 slides. But essentially, the premise of this fund, and this is just the pure positioning, the premise of this fund is very simple, right? You see from the fund industry today, multiple NFOs on many sector funds, many thematic funds. Now, what is the role these play? The role I see it playing is very simple. I think for any investor, 80% of his or her portfolio should be in what your core belief is for the long term, right? Which is, for example, your core belief is that if the economy will double in the next 5, 6, 7 years, ideally, as long as I say invested sensibly in diversified funds, diversified portfolios, the chances that my wealth will double for that money that I've invested is reasonably high. How do I add some element of excitement or some element of trying to improve on the return that the core portfolio gets? I look at tactical opportunities. My submission, and the reason we launched this fund, is that over the next 7-8 years, anybody's ability to predict which will be the super SaaS sector at the end of the 7th year is next to impossible, right? Which is going to be the overarching theme that will emerge victorious from a market result standpoint in the next 7 years is next to impossible. And so therefore, rather than playing the tactical portion of your portfolio by saying, today I'll buy IT, next quarter I'll buy pharma, the quarter after that I will buy banks, look at giving that money to a business cycle kind of investing concept. Leave us with the tough job of trying to figure out which cycle is becoming relevant for a particular sector or a particular theme is playing out, and therefore its consequences, and we will keep adjusting it. So I would probably position this fund as a diversified fund, but which is multi-sector, multi-theme. And we will obviously, there is no guarantee that we will succeed, which is why you saw on the previous slide, the risk of a fund like this is positioned slightly higher than a diversified classic, flexi cap fund, for example. But we believe that there is an opportunity, as Howard Marks has obviously done over the last 3 decades, in thinking about investing in a slightly different fashion, a fashion which I think is becoming more and more relevant in our marketplace, where world is dynamic, opportunities are dynamic, and also possibility of destruction coming very quickly is also very dynamic. And your ability to think about it in that context is what this fund is all about. So essentially, the portfolio construction is going to be really driven by a top-down view, right? We've got to be able to think about what is happening upper se, and where it will therefore impact certain sectors and subsectors, marry it to where we believe the market seems to be pricing that opportunity or that potential situation where things are going to get difficult, and then try to optimally allocate. Okay, so that is basically what this fund is about. I'm going to stop here and I'll be happy to take questions. I hope this was useful. Like I said, this is not a classic NFO presentation, because I think for anybody, it's important to understand the thought or the concept behind the idea rather than purely the fund itself. And I hope that my presentation to you made that reasonably clear. I'm happy to take any questions now.
Dear participants, in case you have any questions, you can put it on the chat, please. Sir, we don't have any questions at this point of time. So thank you everyone for logging in for the webinar. In case you have any queries or questions, you can reach out to the teams concerned. Thank you. Thank you, sir.
Thank you very much. Bye-bye.